Welcome back, everybody, to Chapter 4 and video number 3. Here, we're going to show you how to do a reconciliation of a bank statement. And what we're doing here is we're comparing what we receive on the bank statement to the company's cash records. There's always going to be a difference. There are timing differences for the most part. But we also sometimes have errors that we make as a company, or even the bank makes. The bank doesn't make too many, but they do make them occasionally. So, a bank reconciliation matches that balance of cash in the bank with the balance of cash in our own records. And so we're going to look at how those timing differences occur before and after, and what kind of errors might occur. So here is our accounting records here on Starlight Drive-In. So as you can see, we have a lot of sales receipts, and that's going to increase our cash receipts. And then we're going to have some cash disbursements for some of the expenses we have for salaries and rent, etc. So, if I take the cash receipts, in this case of $77.80, add that to the beginning cash balance, back out the cash disbursements, then we're going to have our ending cash balance. In this case, as of March 31st, 2021. This is our bank statement from the first bank. Here, essentially, we have the same kind of information. Cash in and cash out. So as you see, the ending cash balance here is $4,100. But we have a variety of different items on this bank statement. And the footnotes of those are down here, descriptions. And you can see we have a customer deposit. Sometimes the bank will collect a note for us. We have electronic funds transfer, EFT. We have interest that's earned. Customers deposits a check. DC stands for debit card. And sometimes we give a debit card to our people for them to use for business purposes. But there's also bank service fees. And occasionally we have a customer who bounces a check, as we call it. That's called not sufficient funds, NSF. So you can see that there. All right, so we're going to reconcile the bank's cash balance here. Now, always do it this way, you guys. Don't get creative. This is really easy if you do it the way I tell you here, okay? We're only going to do two things on the bank side, unless there's a bank error. We're going to have some deposits outstanding. What is that? Well, what that is let's say at the end of the calendar year, December 31st, we run down to the bank, and at 7 o'clock at night, we throw our deposit for that day in the bank depository. The bank has not recorded that on their records, but we have on the company side. So we're going to correct the bank. The bank, in this case, we're going to adjust it by adding that deposit to the bank balance. We also have some checks that the company has written, and we've subtracted all those checks that we've written from our book balance. But not all of those checks have cashed. Sometimes we refer to a cashed check as canceled check, or a number of terms for the same thing. But if it hasn't been cashed, and the check is still in the hands of the people to whom we issued it, then it's outstanding. And we have to subtract that from the bank side. Those are the only two things you want to do on the bank side unless there's a bank error. You add deposits in transit, it's sometimes called, or subtract checks outstanding. Does that make sense? Okay. The company side is a little different. But before I get into the company side, I want to say that if there is a bank correction, like we just did in step 1, we don't make any subsequent journal entries. Even if there's a bank error, we don't make any subsequent journal entries. If there is a bank error, we call the bank up and we say, hey, there's an error, please fix it on your side. We don't do that. That's the bank. The other two, deposits in transit and outstanding checks, are timing differences that will resolve themselves in the next period usually, or eventually. All right, so now, the company side. The cash transactions recorded by the bank, but not the company. So here, the company has collected maybe a note on our behalf that adds to our balance. They may have had some interest on the daily balance. That adds to our cash balance. But we also may have done some electronic funds transfer that we haven't accounted for. That's going to decrease the company's cash balance. We might find out about a not sufficient funds check on a customer. We might have some debit card purchases from perhaps our maintenance staff, where we give them a debit card to run down to the local hardware store and buy things for the plant. And then, of course, our bank fees. And it is also possible that the company has errors as well. We need to fix all of these with journal entries. All right, so the differences in cash collections here. Here, the company records these cash receipts, and we look down here, and we find that we have a sales receipt here that's not on the bank statement. That's a deposit in transit or a deposit outstanding, and that we're going to fix on the bank side. Okay, and however, here we have a note that the bank has collected for us, and it includes some interest as well on the bank statement. So that $3,000 note includes $200 of interest as well. So now we take a look at our company's records again, and we find out that we wrote a check for utilities and supplies, and that those check numbers were 295 and 297. As I look over on the bank statement, 295 and 297 are not present. Those are outstanding checks, and we're going to deduct those from the bank side. Okay? All right. Over here, though, we find some other things. The company made an error of $300. Here we have some electronic funds transfer of $400, not sufficient funds of $750, $200 of debit card use, and a bank fee of service fee of $50. So, what does a bank reconciliation look like? Here it is. And I always do it just the way that they've shown on this slide. The bank is on the left, the company is on the right. So, the balance per the bank statement was $4,100. We added in our deposits in transit, or deposits outstanding. we subtracted out our 2 checks that were outstanding, and that gave us an adjusted bank balance per the reconciliation of $4,200. Over on the company side, a whole bunch of stuff went down. They received a note for us, $2,800, but as they indicated, $200 of that was interest earned. They recorded $3,000 here. And so we have to, also, we had our running balance in our checking account. Companies get interest on that generally, and we got $20 for that. However, one of the checks that we recorded went bad. So when we get a check, what we do is we debit cash and credit accounts receivable, as I think you may know by now. But now, if it's an NSF check, I have to put that back. So I'm going to have to debit accounts receivable and credit cash as my journal entry here. So remember that when we receive that check, we assume it's a good one, and we do a journal entry to make that happen. In this case, it was a bad one, so we have to undo that. And I might point out, if there's any bank fees associated with an NSF check, which there almost always are, we're going to include that in the receivable to that customer as well. They should pay for that NSF fee, not us. So then we have our debit card for office equipment, $200, electronic funds transfer that sales department used for advertising, service fees that the bank charged us for $50, and then we corrected the rent expense errors, and as you see, the adjusted balance per the company's books was $4,200, which matches the adjusted bank balance per the reconciliation. Okay, so which of the following items would be found on the bank side or the left-hand side of the bank reconciliation? And if you said answer bravo, deposits outstanding, you would have been correct. The only thing you want on that left-hand side is outstanding checks and outstanding deposits. Okay. How would an NSF check from a customer be treated on a bank reconciliation? Well, we are going to deduct that from the company's side, pretty obviously, because we didn't receive that cash. All right, sometimes students mistake an NSF check as a bad check written by the company. No, this is a bad check written to the company. So when a not sufficient funds check does occur, the company has deposited the customer's check, but the customer didn't have enough funds to cover it, so we must adjust that cash backwards to reverse the increase in cash it recorded at the time of deposit. Very important to understand that. So the effect of this bounced customer check creates an accounts receivable for the company until the customer eventually honors the funds it owes. All right, now, how do we update the company's cash account? Well, we examine the items used to reconcile the company's bank balance, and then we debit cash for the items that add to the balance, and we credit cash for the items to subtract from the balance. This is probably a good time for us to stop video number 4 here, and when we return, we will look at the journal entries that we need to make to adjust the company's side of the bank reconciliation. Until that time, bye for now.